I am pleased to introduce Chicago Federal Reserve President Charles Evans. Charles, thanks for joining us this morning. Nice to have you on set here, and you can face the grilling from the whole crowd in just a minute. I want to ask you a couple questions. Can I say WTF? Is that allowed? Is that?
Well, you just said it.
No, I'm asking if I can say it.
You can sort of get away with that. I think you can get away with that.
What's going on, Charlie? We were down. We were coming down for the count. Recession was inevitable. The market had sold off. And now it looks like the data's coming back. The market's up 16%. What's your view on the economy and the outlook here? Is there recession inevitable at this point?
Well, Steve, the data has strengthened a little bit in recent weeks. I think the first quarter is looking a little bit stronger than I might have thought at the end of December, early January. Some weak data rolled off. So, the economy is doing solidly, I would say. Fundamentals continue to be quite good. And so anybody who is overly concerned about a downturn, I was never really concerned about that. I do think that inflation is a little weaker than I would like to see, given strong labor markets, low unemployment rate. Wage growth has picked up 3 to 3.25%. And so there are a lot of fundamentals that support continued strength in the consumer. I'm looking for growth in 2019 on the order of trend growth, which 1.75% to 2%. So that's decelerating from last year's 3% growth. But yeah, the economy's doing fine.
If you had to make your best guess as to the next direction of a policy move, which way would it be?
I don't have to make that guess. That's the nice thing. I submit a forecast.
But I mean, that's an interesting answer, right? You're saying you're firmly neutral. You don't have a bias either way right now?
You asked me if I had to make a guess. I don't have to make a guess. I put in a projection of what I think appropriate monetary policy is that is underlying the forecast that I have. So I said I have a forecast for 2% growth, say, in 2019. And it's been decelerating. And I think that the unemployment rate is likely to go sideways. It's at 3.8. Maybe it goes down a little bit. Maybe it doesn't, depending on labor force participation. What is a little concerning to me is that inflation has been underrunning 2%. And I had been thinking that inflation was finally going to be solid, hit 2% in a sustained basis, maybe go over a little bit. That was my projection. And on the strength of that, I had, as recently as September and December, thought that maybe a couple of rate hikes were in our future because inflation's a little bit lighter. The economy's doing fine. I think I said a couple of weeks ago that I can see the funds rate being flat and unchanged into the fall of 2020. For me, that's to help support the inflation outlook and make sure that it's sustainable at 2 or a little bit above. That would be fine too.
So is December looking like it was a mistake to hike rates?
No, I don't think so. I'm quite comfortable with the rate move decision and everything that we said in December. The funds rate is at 2.25% to 2.5%. That's what we're targeting. That's a good place to be with the unemployment rate at 3.8%. I think that can support continued employment growth. I don't know what maximum employment is exactly. I think we can continue to probe. Wage growth at 3 to 3.25% is indicating, businesses tell me that labor market conditions are tight. They're having trouble finding workers, but they're bidding that up, and we keep getting employment growth. So I think that's a good environment, and until cost pressures lead to higher inflation, I'm happy to just sort of be data dependent and look at how things are playing out.
Steve, what were Fed funds in 06 and 07? Just a ballpark number. What do you think they were?
5-ish, I think. 5.25-ish. I can tell you exactly.
We topped out at 5.25.
So you have
5.25.
You have the
right
financial
there.
crisis.
Not bad.
They have the financial crisis. We do these we were talking about this earlier. We do these emergency measures to save the
we had a big downturn. We had housing crater.
Do all that. I always thought once we're back to normal, we stepwise go back to where we were normalized. We go back to 5. And now it just looks like that's not the case. And I'm wondering, is it because we did build up a lot of debt that we don't want to go back up there because the debt service would really be prohibitively expensive? Or, I mean, compared to where the unemployment rate is, we should be back to 5 easily, shouldn't we? We were never at 3.8.
If you did a scatter
before.
chart, there's no way you would put the unemployment rate in the Fed funds where it is. But Charlie would tell you.
Joe,
what changed? I don't.
Joe, that's a great question. That's a great set of observations. And what's changed is the state of the economy. Labor force participation rate has declined quite a lot since 2000, 2005, 2006. This was anticipated. My own staff early in the 2000s looked at the demographic capabilities and noticed that labor force was going to start declining. And so, that was going to put pressure on the economy to grow at the previously higher rates of 3 or 2 3/4. Now, labor force growth isn't going to add to trend growth like it did before. We used to enjoy 3.25% growth during expansions from 82 to 2007. Now we're looking at 1 3/4%. Why is that? Well, I look for labor input growth, best of circumstances going forward, about 0.5%, and productivity growth to be about 1.25%. That's a good rate. That's higher than the productivity slowdown years of 73 to 95. It's not as high as the golden years of 95 to 2005. It's in between, and that gets you to 1 3/4. So in that environment, interest rates are going to be lower. That 5.25% funds rate back then was on the restrictive side. Now we think neutral is about 2 3/4, and we're on the low end of that. I'm okay with it.
What was the inflation rate too compared to the Fed funds?
It was 2.5%.
So we're only 0.5% below that, and yet rates are.
Oh well, we're about 3/4% below that, and expectations at that time were firmly at 2.5%. They sort of supported that, and we needed to do more. Now they're under that, and we need to have. Be careful, Charlie, in order to get expectations
how
up.
Serious is your concern
Things have changed
about inflation?
a lot since the mid-2000s. That's the answer to my
If your concern about inflation is strong enough, then that would lead you to additional easing, wouldn't it?
It certainly argues against premature tightening. It argues against moving to a restrictive position prematurely. I want to look at the data. At the moment, it looks like inflation is on the light side. It is, and expectations aren't high enough. But I had, in September, thought that we'd be in a better position if the data comes in.
Can you make the case for a cut right now?
I'd have to be expecting some kind of negative shock, which at the moment I don't see. I think it would be unexpected. I mean, most recessions are unexpected. We're going along. The economy's doing well. There's no reason to think that the expansion is going to die out of old age. The little pause could be the one that refreshes and we keep going. But I don't want to move to a restrictive position prematurely.
Because rates are so low, is the bar higher now for any reversal of policy because you don't have as much ammunition?
I don't think so. I'm not sure I understand exactly.
In other words, before you would reverse policy and cut, is the bar substantially higher now than it otherwise would be?
So we have less capacity to cut rates if we get into a downturn. So, on the one hand, it's just hard to say. I think you have to look.
Can go negative.
I think you have to look at where you think the economy's going. I think if you think that it's slowing down, you want to get out in front of that. At the moment, I think things are going pretty well, and I'm comfortable with the setting for policy.
What do you think, by the way, talking about new math?
New math. You can go negative.
Well, that's
keep cutting until you're at -5, dude.
I wasn't going to.
They do it in Europe, don't they?
No, they don't go to -5.
I know,
they go to like -40 basis points.
That's bad enough.
What do you think more largely about sort of this sense in Washington among Democrats and progressives that you can just blow out the budget?
MMT.
Doesn't matter. MMT.
Modern what?
Modern monetary policy.
Theory.
So as sort of a research-oriented economist, I'd like to see a well-articulated model, and I haven't seen that. The best kind of analysis I've seen from that is, along the lines of Paul Krugman and maybe Brad DeLong and others commenting about this. And there is a line of thinking that goes back to Alvin Hansen that back in the 30s and 40s about how it's the state of aggregate demand that puts pressure on resources that can fuel inflation. Aggregate demand can be fueled by fiscal actions, and if you were able to regulate that in a particular way, perhaps you could use that. I think a problem with that, Chair Powell mentioned this earlier, is that you don't normally look for Congress to do short-term fine-tuning. I mean, just the way you get to a bill and get it passed is really hard. So that's why you look to the Fed to do things like that. Plus, it's monetary policy, it's inflation, it's inherently monetary.
Charlie, the president commenting again over the weekend about the Federal Reserve, saying that the market would be 5,000 to 10,000 points higher. I assume he means the Dow, but
yes,
for sure. Yeah, okay. If not for the Fed, how do you react to this commentary? Do you think it's appropriate that the president comment the way he has been commenting on the Federal Reserve, and does it change your policy?
It's certainly the case that the Fed enjoyed, a period of time since the early 90s until recently where, the administration was relatively quiet about Fed actions. Even if they graded on them, they were relatively quiet. The Fed chair and the Treasury Secretary have breakfast and lunch on a regular basis, and I'm sure they exchange views there. But, we asked for some degree of independence from political authorities. I think what comes from that is, we have to be accountable, we have to explain what we're doing, and we have to follow the mandates of the Federal Reserve Act, which is to provide financial and monetary support to deliver maximum employment and price stability. And I try to keep my eye on the ball.
There's been a lot of commentary, though, over the past several weeks about the status, if you will, of the Federal Reserve, just within as an institution, the credibility of the institution. Given some of the comments that the president's made,
such as the Mario Draghi comments over the weekend,
given but also I was going to say the nomination of Herman Cain, the nomination of Stephen Moore. You've read those stories that people lamenting the credibility, long-term credibility that they argue could ultimately be undermined by some of this. Do you have sympathy for that argument? Do you disagree with that argument?
It's very much what I was just saying, which is, we have to pay attention to the data. We have to pay attention to our mandates. I think when, we take some actions, like in December, you asked me, did I agree? Was that a mistake? I'm willing to explain to you that I think that it was a good decision. We can disagree over that. And since then, the data softened a little bit. Now they seem a little bit, stronger. I think that supports just sort of, let's be data dependent and look at how this will play out. And I have an idea that it might take longer. In the meantime, people are going to criticize this, and that's the way it plays. As long as we continue to look at the data, can explain it relative to what we're supposed to be doing, we just have to accept criticism. And if you're in this and you don't have a thick skin, then you really have to consider how to grow a thicker skin.
Come back anytime, Charlie. Thank you very much.